it's not just the BOK, right? The whole week we've been talking about the Fed and central banks maybe now leaning towards that sort of downshift in this tightening cycle. Are you subscribing to this kind of peak rates, peak inflation narrative now?
Well, I'm starting to gravitate in that direction. I mean, I think that inflation is starting to show signs of easing. That's a good sign. And what came through quite clearly from the Federal Reserve meeting is that they are prepared to step down in terms of the pace of rate increase. But they were quite ambiguous in terms of what the terminal rate will be. And they also flagged out the risk of a recession. That's what came through in the FOMC minutes that just came out a couple of days ago. So there's still, uncertainty, ambiguity, a lack of clarity of what the Fed will do. The Fed is keeping its language very ambiguous at this juncture. And so, the markets will have to take its cue from employment data, inflation data. And, I think the coming months will give us a better clue. So it may be too early to jump the gun, but the initial signs show that inflation appears to be slowly rolling over, and the Fed is likely to slow the pace of rate increase, and maybe even signal at some stage in the first half of next year that it's done with rate hikes, at least for the time being. So the markets are hopeful of that, and I wouldn't be surprised if that happens. Maybe not just yet, but in the first half of next year.
First half of next year. The bond markets, at least where the yield curve is showing that inversion, is signaling that concern of over tightening from the Fed. Do you then have to just basically stay short duration until the Fed actually does something and actually pivots? Or is there actually more value now to be put in the fixed income space?
Well, I think there's clearly value to be put in the fixed income space, especially in the investment grade space. I think there's some room for longer duration at this juncture. As I said, come first half of next year, if the Fed turns more dovish, clearly turns more dovish, and if there are signs that interest rates will start to, ease off, maybe in the second half of next year, or even in 2024, the bond markets will react ahead of time. And if we see a recession happening next year, then investment-grade bonds would be one good area for investors to put their money into, because it provides some degree of a recession hedge as well. So I wouldn't ignore the bond markets. I think the bond markets have been seeing good inflows, and what the Fed has said in the last few weeks has given greater conviction to put a bit more money into bonds.
Even with the downshift that we're getting signaled from central banks, there's still a fair bit of tightening to come. Do we need to accept that perhaps we're entering an era for lower returns for equities?
Without a doubt, I think investors have to come to terms with the fact that the returns from equities will not be as strong as what they saw in 2020 and 2021. Will not go back to those days, because the era of tightening is going to be there. I think what came through also clearly from the FOMC minutes is that the Fed will keep policy restricted, possibly for an extended period of time. So in other words, the Fed could take the terminal rate up to 5% and keep it there for a while. So rate cuts may not take place until maybe the end of next year or even 2024. So, and don't forget, we are seeing quantitative tightening take place at the same time that rates are being increased. So, it's a double whammy, and I think that calls for some degree of caution. But, a lot of the bad news has been priced in. So you don't want to be too overcautious as well, because you might end up missing the boat.
How about China? Do you feel a lot of the bad news has been priced in there? Because it looks like a pretty rough ride heading out of COVID coming ahead. Is it too early to re-enter that market yet?
Actually, we have been positive on China for a couple of months, and we've not been wrong. The MSCI China index bottomed sometime in October and has rallied more than 20%. So we remain positive on China. We think that if you're a long-term investor with risk appetite, the stomach for extreme volatility, yes, China provides pretty good opportunities. Yes, the COVID numbers are at a record high, but on a per capita basis, it is still fairly low worldwide. And the numbers that you have right now is nothing like what you've seen coming out of other parts of the world, like the US and Europe at the start of this year when COVID peaked. So the numbers in China are still relatively low. And I think the Chinese government is quite intent on helping the economy to get back on its feet now that they've sorted out the politics. And I think, you got to be a medium-term investor in China. Don't look at the next 3 months, 6 months. You got to look at the next 2 to 3 years. It'll be a volatile bottoming process that's going to take place, but I think 2023 is going to be a relatively good year for China.
Okay, that's looking a little bit more optimistically. I'm just wondering, how does the dollar kind of play out in all this as well? I know you're still pretty cautious when it comes to EM. The reversal that we've seen in the greenback of late, does it give you much confidence that maybe the path of least resistance is lower for dollar now?
Without a doubt, I mean, the dollar is actually, the DXY index has pulled back about 7%. When I last looked at my Bloomberg terminal a short while ago, the peak was somewhere in September, late September. It's pulled back 7%. That's quite substantial. And, as we discussed earlier, if the Fed is going to slow down the pace of rate increases, the dollar could actually go sideways, moderate. And that's good news for the rest of Asia. I was just listening to an interview with the Bank of Korea governor, and he highlighted the fact that the weaker dollar has given Asia a respite, and we are starting to now turn more positive on Asia, not just China, but positive in Asia as well, because Asian currencies could benefit if the dollar eases from its upward trajectory.